Sir Isaac Newton could map the cosmos. He invented calculus and discovered gravity. Yet despite having one of the most disciplined minds in human history, he lost his entire life savings in a single stock market crash. After watching his fortune vanish, Newton noted, "I can calculate the motion of heavenly bodies, but not the madness of people." That madness took hold of Great Britain in 1711. The nation was struggling under a massive debt load, the leftover bill from years of fighting the War of the Spanish Succession. In this era, the concept of a public company was a dangerous novelty. No requirements to publish balance sheets, no independent auditors to verify profits, and no legal framework to stop a founder from simply walking away with the treasury. This combination of national financial desperation and a complete lack of oversight created the perfect vulnerability for a grand-scale con. A businessman named John Blunt proposed a solution. He would consolidate the government's war debt into his newly formed South Sea Company. In exchange for taking on the government's liabilities, Blunt demanded a monopoly, exclusive rights to all British trade in South America. There was one glaring problem. Spain held total control over South America and refused to let British merchant ships anywhere near those ports. Because Spain controlled the ports, the South Sea Company had no actual trade routes and no physical way to move goods. Blunt had effectively convinced the British government to back an 18th-century vaporware company with no viable way to make money. Since he had no actual trade profits, Blunt pivoted to manufacturing hype. He launched what was essentially the first hyper-aggressive PR campaign to drive up the stock price. He seeded rumors throughout London about unimaginable wealth, claims of gold, silver, and spices just waiting to be shipped back from South American mines that his company couldn't actually reach. To pull in buyers, he allowed stock purchases on credit. With a 10% down payment, an investor controlled 10 times the stock. This drew in everyone. Politicians took secret shares, while commoners emptied their savings to chase the rising price. This chart shows the result. Between January and August 1720, South Sea stock rocketed from £128 to over £1,000 per share. The frenzy was so intense, it sparked a wave of copycat shell companies in London's coffeehouses, all trying to cash in on the public's desperation to get rich. One entrepreneur raised thousands for a company described only as an undertaking of great advantage, but nobody to know what it is. He took the deposits and fled that afternoon. Extreme leverage and manufactured rumors had completely detached the stock market from any underlying economic value. By late summer, the company directors saw the writing on the wall. They realized the stock price was a fiction that couldn't be sustained. They began quietly selling off shares, converting paper wealth into millions of pounds in cash, before the public realized the business was empty. When the public noticed the insiders were exiting, the confidence holding up the price vanished instantly. Panic hit the market. By December, the stock had crashed back to £12. Thousands of families lost everything, and the scandal reached the highest levels of government, sending prominent politicians to the Tower of London. The South Sea collapse proved that a market built on nothing but blind confidence will disintegrate the moment the architects head for the door. The shock of the crash forced the British government to develop the very first tools of financial regulation. They passed the Bubble Act of 1720, which restricted how companies could be formed, and established the requirement for independent corporate audits to verify a company's claims. These reforms introduced the principle of financial transparency. Today's mandatory corporate disclosures and margin rules are designed to prevent the same kind of speculative domino effect that nearly broke the British Empire 3 centuries ago. But while the rules changed, the underlying human psychology didn't. The formula of high leverage, aggressive hype, and the fear of missing out remains just as effective now as it was in 1720. The 1720 investors threw money at a secret business model they didn't understand. Today, billions flow into unregulated crypto tokens and meme stocks with no revenue, driven by the exact same impulse. It leaves us with one question. Is modern society actually any wiser than the people of the South Sea bubble, or do we just have faster Wi-Fi?